So today I'll be teaching first lecture of FR, which is FR lecture number 1, property, plant and equipment. And this standard relates to the non-current asset portion of the syllabus. So today we'll be starting with property, plant and equipment. What is property, plant and equipment? To understand what is property, plant and equipment, let us first understand the asset. What is asset? Right? Asset is anything which gives rise to future economic benefits is known as an asset, right? For example, a machinery for production is a property, plant is an asset because it helps an business to get an future economic benefit. Future economic benefit is the future income or future cash flow which we will be generating after selling the goods. So that is the definition of asset. Now there are two types of assets that we all are aware of. One is non-current asset and the other is current asset, right? So let us understand what is current and what is non-current as well. So current assets and non-current assets, right? What is current asset? Current asset is when the life of an asset is less than 12 months, right? It is called a current asset. And when the life is greater than 12 months, it will be a non-current asset, right? So now let's talk about property, plant and equipment. So what is a property, plant and equipment, right? The standard for property, plant and equipment is IAS 16. Okay. So property, plant and equipment, there are two things. One is, it is a non-current asset. It is tangible in nature. So what is a tangible asset? What is a tangible asset? Tangible asset is an asset which can be felt, touched or seen, right? So this calculator is a tangible asset because I can see it, and a brand or what we can say, a patent is a non-tangible, intangible asset which we cannot see and touch. So that is the difference between tangible and non-tangible asset. Now what is different in property, plant and equipment? It is held for first thing, held for production and supply of goods and services. Okay. Second is it is used for administrative purposes, right? And the third is rental to others. So this is a special criteria in property, plant and equipment. So we have to remember this, right? By heart this, because this is the exact definition that we have to remember for this property, plant and equipment. So please, you can write it in your notes, right? Now moving forward to the recognition criteria of PPE. Recognition criteria. Okay, what is the recognition criteria for PPE? The question that it answers is should we recognize all assets as property, plant and equipment? Or rather, should we recognize all assets in our books or not? So the first criteria is future economic benefit is probable to flow to the entity and the second is cost can be measured reliably. So these are the two conditions which we'll be using for the recognition criteria. These three things that I have marked, these two things that I have marked are the keywords which we have to remember. First is future economic benefit and the second is cost can be measured reliably. So you have to remember all these 2 points for the recognition criteria. Now moving to the most important thing. So the most important thing is the measurement principle. This is the most important thing because what it helps in identifying what value should we recognize in the books, right? So there are two types of measurement. First is initial measurement and the second is subsequent measurement. Right? So what is the difference between initial measurement and subsequent measurement? So initial measurement is a measurement which is done in the starting of the year, right? And the subsequent measurement is after we have purchased the asset, right? This is on the date of purchase of the asset, right? On the date of purchase, right? This is on each year end, right? So this is the difference between the initial measurement and the subsequent measurement. Moving to how to calculate the initial measurement, let's move on to the next portion, initial measurement. So initial measurement, in initial measurement what we have to remember is, first, what is included? Purchase price less any trade discounts. Okay. Second thing that we have to remember is we will include non-refundable taxes. Okay. Third thing that we have to remember is borrowing cost, right? This is a separate standard which is IAS 23. We will be covering it later. Okay. In today's lecture, we will not be covering the borrowing cost, most probably. So borrowing cost will be covered in the next lecture. So purchase price, non-refundable taxes, borrowing cost. Now comes directly attributable costs. And the last is provision for dismantling or restoration, site restoration. Okay. So these are the 5 things that we have to remember for initial measurement. Now let us understand one by one. What is the purchase price? Purchase price, let's say X is a seller and Y is a buyer, right? So imagine that we are the buyer, right? We are the buyer. Okay. So if we are the buyer, X sold us goods worth 1 lakh, right? This is a machine that X sold 100,000, right, dollars to Y, which is us, right? Sold for 90,000, right? So what is the purchase price? Purchase price, is it $100,000 or $90,000? So the answer is it will be $90,000, because when the purchase price we are determining the cost to us, right? The cost to us is 90,000. So in the books here, taking an example, we will include 90,000 here, right? Now coming to the same example, right? Let us take the same example. The portion of non-refundable tax which can be VAT, right? Or if we are talking in Indian terms, it can be goods and service tax, right? So non-refundable taxes, VAT or GST. So for example, there is a VAT of, I am saying, taking an example of 20%, right? So 20% of 90,000 is 18,000, right? So we will include 18,000 as non-refundable tax. And we have not covered the borrowing cost till now, so I am taking a example only. So borrowing cost is, I am assuming 2,000. Okay, so we will include 2,000 as our borrowing cost. Okay, now coming to directly attributable cost. This concept is very important. So in this concept, I'll go to my notes and I'll tell you what are the costs which are directly attributable. So directly attributable cost are those costs, okay, which are incurred to bring the asset into a condition, into a ready to use condition. Okay, directly attributable costs are the costs which are incurred to bring the asset into a ready to use condition. Ready to use can be also referred to as intended use. Okay, intended use. Okay, so these are the costs which are incurred by the company to bring the asset into a condition where we can use the asset, right? For example, if we have purchased the asset, right? For example, I have purchased the asset. I am in Delhi currently, and I have purchased the asset from, let's say, Mumbai. Okay, I am in Delhi and I have purchased an asset of, assuming the same example, I have purchased this asset of 90,000. Okay, now the transportation cost that I incurred to bring the asset from Mumbai to Delhi is the transportation cost that I incurred is, let's say, $10,000. Okay, I have incurred $10,000 to bring the asset from Mumbai to Delhi, right? And to fit the asset, I have incurred a cost of leveling of land, right? I needed to fit the asset. I needed to fit the asset in my factory. Okay, for example, let's say this is the factory. Okay, and this place was very, not in a condition to fit a machine. So I incurred a cost and I made this land flatter so that I can now fit the machine here, right? To fit the machine here, I did leveling of land cost, which costed me $1,000, and transportation cost is $10,000. So these costs are directly incurred to bring the asset into the intended use. This transportation cost, you can understand that it is directly attributable to an asset, right? But how is this leveling of land related to the machine, right? So if we did not have incurred this cost or leveled our land, what would have happened? We would have not been able to fit the machine in our factory. So we cannot use the asset until we fit it properly, right? So that is why this cost is also directly attributable. Okay, directly attributable. So I am assuming that we have incurred total of 10,000 and 1,000, which means we have incurred a total of 11,000 as our directly attributable cost. Okay, so directly attributable cost is clear. Now in this example we will take here 11,000 as directly attributable cost. Now moving on to provision on dismantling. This is very important, right? You have to listen to me carefully, and there are two things that you have to need for FR. First, provision for dismantling / restoration. So firstly, I would request you all to have a calculator with a GT function in it. Okay, there is a button named as GT, which is the full form of GT is grand total. Okay, grand total. So this will help us in leases chapter. Okay, this will help us in leases chapter. And today, to calculate the provision for dismantling and restoration, what would we need? We would need present value factor. Okay, present value factor. Why do we need a present value factor? Let us understand. For example, there is a project of Reliance. Okay, Reliance has been digging to get oil out of it. Okay, this is a oil plantation and Reliance had dig in this factory, and now the oil is coming out here, and this oil will come out till a particular date, and that date is let's say after 5 years, right? So if Mr. Ambani is drilling this, right, because it is a Reliance oil company, so if Mr. Ambani is digging oil out of it, this land will get damaged, right? Land will get damaged. Now government will not leave Ambani, right? Because obviously if he has destroyed this land, it's his responsibility to restore it. So it is assumed that Reliance will incur $500,000 to restore the site after 5 years. Okay, after 5 years. This is clear. Now let me take an example. Okay, this is an example where we will be incurring 500,000 here, and we want the present value here. This is year 0, which is the today's date. This is year 1, this is year 2, this is year 3, this is year 4, and let's say this is year 5. This is year 4, this is year 3, this is year 2, and this is year 1. Right? Now I have to calculate the present value of this machine on this date, right? Present value. How will I do it? The easiest method is not by the formula but by the calculator, because we can use calculator in our ACCA exam. So what we will be doing is we will be typing 1.1 and let's take an assumption that interest rate is 10%. Okay, interest rate is 10%, and I'll take two examples in which one interest rate is 10% but the second interest rate is 5%. Okay, I'll take two examples and we will also see what will be the difference with difference in interest rates. Okay, now I am taking an example of 10%. So we will be taking here 1.1. We will be pressing in calculator divide two times, right? And then we will be pressing is equals to n times. What is n? N is the number of years. So this is clear. Let's do it. 1.1 divide 1 2 3 4 5. So the answer that I am getting is, after doing this, is 0.620. Okay, this is the answer that I got, and this will be our present value factor. Now to get the answer, what will be the present value of this $500,000? What we'll be doing is we'll be multiplying this present value factor into the amount, which is $500,000, into 0.620. Now after doing this, I am getting my answer as 310,460. So this is the present value of an asset. So we will be writing as 310,460. This will be the present value on year 0. So what will happen? We will go up and we will add 310,460 in the cost of asset. Okay. Now after totaling this, what will be the total of the amounts? Let's do it. 90,000 plus 18,000 plus 2,000 plus 11,000 plus 310,460. We will get 431,460 Okay, so this will be the total value of property, plant and equipment. Okay, this will be the total value of property, plant and equipment. I hope I am clear on this one. Moving forward to the subsequent measurement. Okay, what is subsequent measurement? In subsequent measurement as well, there are two conditions. Subsequent measurement, there are two conditions. One is cost model and the second one is revaluation model, right? So in cost model, what happens? We depreciate the asset over useful life. If there is a provision, right? If there is a provision, we will charge finance cost to the asset, finance cost to the P&L statement, right? Statement of profit and loss. After charging this provision to statement of P&L, we will also capitalize the finance cost into the provision. Okay, now the thing that I have written here, I'll do it practically. Okay, now coming to cost model. Okay, cost model. In cost model, the first thing is the value of asset. What we got, it is 431460, right? The value of asset that we got is 43. Wait, let me. Now this is particulars. This is year 0, year 1, year 2, year 3. This is year 4 and this is year 5. What is the value of property, plant and equipment? The value of property, plant and equipment was 431460. Okay, this was the value of property on first, means today, right? The value of property at year end 1. To calculate the value of property at year end 1, we will have to calculate the depreciation. Okay, what is the depreciation? Depreciation is the value of asset divided by useful life of asset. Okay, so in this case, the value of asset which we have is 431460. We will divide it by the useful life, which is 5 years. We will get the depreciation as 86,292. Okay, so 86,292 will be the depreciation which will go to P&L. So here comes a P and L, and I am writing the in bracket depreciation. The depreciation cost in this year will be 86,292. There as well 86,292. Here as well 86,292. Here as well 86,292. And here as well 86,292. So this depreciation will be common for all 5 years. And now what will be the value of asset at year end 1? So what we will do is 431460, right? Value at year end 1, year and 1, carrying amount of PPE. So what we do is 431460 minus 86292. What is 86292? It is 345,168. So the value here will be 345,168, right? And same for year end 2. Year end 2, we will do is carrying amount of PPE at year end 2 will be subtracting 86,292 to the same amount, to this amount 345,168. We will get 86,290. We will get 258,876. So this will be the carrying amount at year end 2, 258,876. Okay, this will be the carrying amount. And same for the all years, right? If I subtract 86,292 from 258,876, I will get a carrying amount of year end 3. Okay, so same I'll subtract this amount from the carrying amount here, right? What I'll do is I'll subtract the depreciation on the previous year's carrying amount to get the current year carrying amount. Okay, so this is the method that we will follow. Now moving on to the subsequent treatment of provision, right? Subsequent treatment of provision. Subsequent treatment of provision. What we will do for the subsequent treatment of provision? Which model? Cost model. Now the opening provision that we had was this is year 0, year 1, year 2, year 3, year 4 and year 5. Okay, now what we will do for all of them? What is the carrying amount for year 0 of the provision? Provision for restoration. Okay, what is the amount that we calculated? The one we calculated was this 310,460. The amount is 310,460, right? Now what we will do in this amount? First, let us see what will go to P&L. In P&L, finance cost will go. Finance cost. Remember when I told you in the starting that we are assuming that the interest rate is 10%, so the finance cost will be 10% of this amount. So guys, the carrying amount of provision on year 0 is 310460 that we calculated previously, right? 310460 when multiplied by 10%, we will get 31046, right? This will go into P&L, and what we will do, we will add this 31046 in the value of the carrying amount. We will add 31046, right, into this amount. Okay, we will add these two amounts to get the carrying amount here. Okay, so what will be the carrying amount? The carrying amount here will be 310460 plus 10%, which is 341,506. Okay, this will be the carrying amount at year 1. Now what will be the 10% of 341,506 is 34150. This will be the finance cost in year 2. Okay, what will be the carrying amount at year 2? Again, we will be adding this 34150 to this amount. Okay, let's add 341,506. We will get 375,656. This will be the amount that we get after adding the finance cost to the carrying amount. Now again, what will be the finance cost in year 3? It will be 37565. Okay, the formula for this is carrying amount into 10%. Carrying amount of last year, or this carrying amount is the opening carrying amount. Okay, opening carrying amount, right? For year 3, what will be the opening balance? The opening balance will be this, right? Because the closing of year 2, which is 375,656, will be the opening for year 3, right? So the opening balance, if I want to calculate what will be the opening balance for year 3, it will be 375,656, right? If I am adding 10% to 375,656, I will be getting the carrying amount on year 3. So if I want to get the finance cost, what will I be multiplying the opening carrying amount into the interest rate, right? So I'll be multiplying interest rate into the opening carrying amount. I'll get the finance cost. And where will finance cost go? Finance cost will go to P&L, right? Now let us calculate the carrying amount of year 3. To calculate the carrying amount of year 3, we just have to add these two amounts, right? We have to add these two amounts to get the carrying amount. So what is the carrying amount? It is 413,222. Okay, this will be the carrying amount. I am ignoring the decimals for now, right? So there might be a difference in your answer and my answer by 0.1 or 0.2, something like that. Okay, so don't get confused. Now I will what will be the finance cost for year 4? The finance cost for year 4 will be 41322, right? This will be the finance cost for year 4, right? Now what will be the carrying amount for year end 4? It is 454,544. I hope that you are getting my point, that every time we want to calculate the provision for the particular year end, we will add the finance cost into the opening balances, right? So let us write a formula. Carrying amount at year end formula is opening carrying amount plus interest rate finance cost. What will be the finance cost? Opening carrying amount into interest rate, right? Got this point? So this will be the cost model calculation for the asset and for the provision. We did it all, right? The capitalization of provision we have already done. What is the capitalization of provision? It is when we will be capitalizing the finance cost every year to get to the closing amount of this particular year, right? So this is how you will be calculating, and the answer for the year 5 you will type in the comment box and I'll reply to the comment and I'll check whether your answer is correct or wrong. Now moving on to the revaluation model. Okay, revaluation model. This is the most important thing and it is widely tested in ACCA. Okay, revaluation model, property, plant and equipment. Okay, so there are revaluation model. I'll be explaining you with the help of a flow chart. Revaluation model. When we do revaluation, either we can get a profit / gain or loss, right? Where will this profit and gain go for the revaluation model in PPE? It will go to OCI. What is the full form of OCI? OCI is other comprehensive income. What is other comprehensive income? When making the statement of profit and loss, let me clear it here. When making the statement of profit and loss, there is revenue, right? Cost of sales, there's gross profit, right? Gross profit. Then there is operating expenses, non-operating expenses, then there is profit before interest and tax, profit before interest and tax, then there will be taxes, and then will be profit after tax. So this is the P&L, right? Remember that this statement of profit and loss is, the full name of statement of profit and loss is the statement of profit and loss and other comprehensive income. So now after calculating the profit after tax, there is one more head in the P&L itself. It is known as other comprehensive income, right? And here it will come revaluation gain on PPE. So this will be the treatment for the revaluation gain for PPE, right? It will go into OCI, and if there is a loss, it will go to profit and loss. Okay, now let us see what happens when there is a subsequent revaluation. Let's see. Now I am assuming that there is a first revaluation. Okay, first revaluation, and the results can be the result can either be a profit or it can be a loss, right? So the first revaluation result is profit, and we did a second revaluation as well. Okay, we did a second revaluation as well. This is a second revaluation. Okay, in this second revaluation, what we got? Either a profit or a loss. Okay, in the second evaluation as well, there will be a profit or there will be a loss. Now what if there is a profit in second evaluation and there is a profit in first evaluation as well? So the first evaluation result is profit and the subsequent evaluation result is also a profit, so there will be no change, it will go to OCI. Okay, now comes the interesting part. If the result of first evaluation is profit and the result of second evaluation is a loss, what to do? The loss will go to OCI to the extent of profit in OCI. Excess will go to P&L. Now I'll take an example. Okay, I'll take an example. There is a profit of 100 rupees in first revaluation. Okay, right, there is a profit of how much? 100 in first evaluation. Now coming to profit in second evaluation. In second evaluation, no matter the profit is 500, okay, it will go to OCI only. Okay, it will go to OCI. But if the profit in first evaluation is 100 and the loss in second evaluation is, I am assuming that it is 150. Okay, so take them as two separate conditions. Okay, these are two separate conditions. In one condition there is a profit and the second condition there is a loss. So I am talking about the second condition, when there is a loss on second revaluation. Okay, so the loss of second revaluation is 150, right? And the profit of first revaluation is 100. We know that. So what will happen is 100 will go to OCI because we have 100 as profit in OCI previously, and the remaining 50 will go to PNL. Okay, so this will be the treatment for the revaluation if there was profit in first revaluation but there is a loss in second revaluation. So I hope that this is clear, and let me know if you have any doubts in this. I'll explain it to you in the comment section, right? Now comes the second condition. What if there was a loss in first revaluation? Okay, this is the result of first revaluation, right? So this is the result of first evaluation, and there's a loss. Now we are doing the second evaluation now. Okay, this is second revaluation. Okay, second revaluation in case when there was a loss in first revaluation. So there can be a profit or there can be a loss in second evaluation. So what will happen if there is a loss in first revaluation and there is a gain in second evaluation, right? Profit will go to P&L to the extent of previous losses, right? Axis will go to OCI, right? Excess will go to OCI. Now let's talk about this condition. What will happen when there is a loss in first evaluation and there is a loss in second evaluation? Simply, in this condition, the loss will go to profit and loss. Okay. Now let's take an example for this condition. There is a loss of, let's say there is a loss of 120 in first evaluation. Okay, this is a loss in first evaluation 120, and there is a profit of 150 in second evaluation. Okay, there is a profit of how much? 150 in second evaluation. So what will happen? How will this be allocated? Let's see. Out of this 150, 120 will go to PNL. Okay, because it will be settled, the loss will be settled, right? From the current profit, the previous loss will be settled, and the excess is 30, right? The 30 will go to OCI, right? 30 will go to OCI. Okay, taking the same condition, the profit is 120, the loss is 120 in first evaluation, and the loss in here as well, it is, let's say, the loss once again it is 90. what will happen? The 90 will go to P&L directly. Okay, now let's see what happened. Let's take an overview for this. Okay, we started with revaluation model and we saw that there can be two conditions. There can be either a profit or there can be a loss. Okay, generally what happens, the profit goes to OCI, right? Generally what happens, the profit goes to OCI and the loss goes to P&L. Now in the first revaluation result, the treatment of profit will be OCI and the treatment of loss will be P&L. Okay, the treatment of first revaluation result, it will be OCI and it will be P&L, right? Now comes, there is a second revaluation that we did. Okay, and the result of second revaluation is profit. What happens if the result of second revaluation is profit, right? Let's say there is a profit of 100 previously, right? And there is a profit of 500 currently. So this 500 profit will go to OCI. Okay, they will do nothing of this 100. But if there was profit in first revaluation, but there is a loss in second revaluation, then what will happen? Okay, this 100, right? This 100 will be settled first from the OCI, right? This loss of 150, right? 100 will go to OCI. Why 100 will go to OCI? Because we have previous 100 profit, which we can settle it, right? We can settle the loss from the previous profit of this 100, right? Now after settling this 100 from OCI, we will transfer the remaining 50 to P&L. Okay, because this is the excess, we cannot settle it anymore, so we will send this 50 to the P&L, right? Now what happens if in the first revaluation there was loss? In the first revaluation there was loss of 120 and it has gone to P&L. Okay, if there was loss in first revaluation and there was profit in second revaluation, right? This second revaluation happened and there was profit. What will happen now? This 120 we have previously sitting in P&L. So what we will do is we will settle the previous loss with the current profit, right? With the second revaluation profit, we will settle the previous loss. What is the previous loss? 120. So we will settle 120 from P&L, right? And the remaining 30 will go to OCI. Okay, this is how we will treat the 150 profit in second revaluation. Now taking a second condition, that in the second revaluation instead of profit there was a loss, right? And there was a loss of 90. So what will happen? We had a previous loss of 120 and we have another loss of 90. What will happen? We will do nothing of this previous loss. We will send this 90 to P&L. Okay, this is the overview, right? This is the overview of the revaluation model that we studied, and I hope that revaluation model is clear now, right? So now let's move on further. We did the revaluation model, we studied the depreciation, right? Now let's study what is subsequent cost. Okay, let's study what is subsequent cost. Subsequent cost can be in two parts, right? Subsequent cost can be in two parts. Either it can be replacement or it can be repairs. Okay, so if there are day-to-day repairs, what will happen of these day-to-day repairs? it will be expensed off in P&L, right? We will expense these off in P&L, right? Now what is the major inspection and replacement cost? Major inspection and replacement cost means that assuming that there is an asset with engine, right? There is engine and there is body. So there are two components in a machine. One is an engine and the second is the body. So this engine is old, right? Is old and now is replaced by a new asset. Replaced by new asset, right? So what will be the treatment? We will capitalize the new and we will derecognize the old part, right? And this body will remain unchanged. Remain unchanged. Let me take an example to make it more clear. Subsequent costs. There are two parts of subsequent costs. One is day-to-day repairs and the other is major inspection / replacement, right? Major inspection / replacement. I'll take an assumption to explain you this. Day-to-day repairs are general repairs, right? For example, oiling of machinery is an expense. It is a day-to-day repair, right? It is repetitive in nature and so that's why what we will do, we will send these types of expense into P&L. Now what is major inspection and replacement? For example, there is a asset, okay, the engine and the body. The engine value is currently at 4,000 and the body value currently at 6,000. Okay, now the engine broke down. Okay, the engine broke down and can be sold in market for $2,000. Okay, what will happen? And replacement engine will cost, let's say, $6,000. Okay, now what will happen? We had an engine of 4,000 previously. So what we will do, we will remove this, right? We have a body of 6,000 and the total asset was worth 10,000. We will replace this, right? Because we have a new engine which is of 6,000 rupees and there is a body which is of 6,000 rupees. So the new asset will worth 12,000 rupees, right? Or $12,000. So what will happen of this $4,000 engine, right? This engine will be derecognized. As we know that we can sell it for 2,000, so we will receive bank account debit 2,000 to engine, right? which will be 4,000, right? And we will recognize a loss account debit of 2,000. Okay, so that is the treatment of old engine, and this new engine we will recognize as an asset. Okay, we will do engine account debit. Let's take it new engine account debit to bank, which we paid 6,000 and 6,000. Okay, this will be the whole effect of this transaction, and I hope this is clear. That is what is let's understand the example of what is capitalization and what is expense. This is the difference between the capitalization and expense. What is capitalization? Capitalization is, when I say capitalization, it means it will be added to the value of asset or liability. Okay, this is when I say what is expense means, what is capitalization means. Okay, and now what is expense? Expense is, it will be expensed in P&L. Okay, this is the difference between capitalization and expense. So now I think it is pretty much clear that how we will be treating the subsequent cost, right? Subsequent costs are of two types: day-to-day repairs and major inspection and replacement cost. So day-to-day repairs directly goes to P&L, and in major replacement and inspection, what happens? There is a replacement of engine or other body other parts which are broken down, or there is some replacement needed for the smooth functioning of an asset, right? Now what will happen? We saw that we will capitalize the new asset and we will de-recognize the old asset, which is this, right? This is the old engine which we de-recognized, and this is the new engine which we capitalized. So the new engine increased our asset value, total asset value, and the previous asset value was 10,000 and the current asset value is 12,000. Okay, because of the replacement of new engine, right? So there will be the revision of depreciation and everything, we know that. Okay, now let's see impairment. We will be studying in the impairment chapter, not now. Let's say how we will be de-recognizing the PPE, right? We will de-recognize the PPE when we sold it. Sold means we disposed it. Okay, we sold it to someone, we disposed it. It is the same thing. No further economic benefits are expected. Okay, if there are no further economic benefits, then we will see, like we will scrap the asset. Okay, we are not able to generate any inflow or income from that asset. So what is the point of recognizing the asset in the books? So then we will de-recognize the asset. Gain and loss on disposal. Obviously we know that proceeds minus carrying amount is the profit, right? It will go to P&L and not revenue. We have to remember this, right? So this is it for the property, plant and equipment. So what are the high scoring ACCA tips? Something is that always mention the recognition criteria. Okay, in FR or SBR exam, mostly in SBR exam, not in FR. In exam, what is when a cost is given, always check, is it directly attributable or is it part of initial cost or post acquisition? Okay, so we have to remember that, right? We have to see whether it is directly attributable or not. For revaluation, increase will go to OCI, decrease will go to P&L, right? Unless revising surplus, we know that we studied revaluation very well today. always compute depreciation separately for components. So there are two or more components in the machinery. For example, let me take an example. The example that I took, the engine and the body, there is a possibility that engine and body both have different useful life, right? For example, the engine had a useful life of 6 years and the body had a useful life of 10 years. So there is a possibility that there is a difference in the useful life. So we will depreciate the asset separately because we know that there is a difference in the useful life. Okay. Restoration cost must be added as provision using discounting. So we know that we did it in the provision part, right? Thank you guys for watching. This was all for property, plant and equipment, and in the next lecture I'll be providing a lecture for borrowing cost and investment property. And please check out my Instagram and LinkedIn page as well. I'll be providing link in the description box below. Also, thank you guys for watching. I provide short content on Instagram, and I also provide valuable content on LinkedIn. So please follow those channels as well.